But you got to ask the question, who is really controlling the interest rates? The Fed can control the overnight interest rates that they charge, but the markets control the rest of them. Now, what you're looking at here...
Gear up for an in-depth exploration of financial markets with Lynette Zhang's newest video, as she examines the captivating topic. Could interest rate derivatives spell trouble for the Federal Reserve? With Lynette's insightful speech and accessible explanations, viewers can expect to gain a clearer understanding of the potential risks and challenges posed by interest rate derivatives in today's economic landscape. So, let's listen to her again.
So today we're going to talk more about interest rates. We're going to talk about the derivatives underlying that, which is so important for you to understand, because my personal opinion is that this is really what will most likely topple the system and be big enough that the central banks cannot print their way out of. Okay, so let's just dive right in. But before we do, I want to remind you guys that, of course, they can change this, and they probably will come with some kind of stopgap measure. But the government shutdown deadline is this Friday. So if you're watching this on Thursday, that's tomorrow. We'll see what they do. They'll probably kick the can down the road. The markets don't even give a crap about it anymore. But let's dive right in. Because our wonderful Larry Summers, and you guys, if you've been watching me for a while, know that I'm not a big fan because of his work back in the late 90s on derivatives, allowing them no oversight. Yeah, great guy. But anyway, he sees meaningful chance that the next Fed move will be a rate hike, not a rate drop. And this is coming up more because inflation is proving sticky. In other words, it's not slowing down as much as they would like so that you're noticing it. They don't want you to notice it because then you make different choices, right? Markets start to speculate if the next Fed move is up, not down, because we handed this over. We handed the Treasury market over to traders back in 2013. Interest rate options reveal some small hedging of Fed hikes, but wow, let me tell you, inflation is not going away. In fact, I am fully prepared to put my technical neck on the line and say we've already seen the beginning of hyperinflation. But you got to ask the question, who is really controlling the interest rates? The Fed can control the overnight interest rates that they charge, but the markets control the rest of them. Now, what you're looking at here is the 10-year Treasury volatility index, which they stopped showing us back in 2016. Thank you very much, because we don't need to know this. But what I want to point out to you is that the global financial system is based on the 10-year Treasury. That's the foundation. And back here, you see how these are all little dashes, which means that the price, if you wanted to buy or sell a Treasury in that day, there was not going to be a whole lot of price movement because the Treasuries were going into stronger hands. 2008 hit, and so instead of dashes, we had small lines. But here you go, 2013, now we've got this volatility. So what this is showing you is that the foundation of the global monetary system is on a foundation that's moving like this. And if they stop showing us that back in 2016, 2017, how bad is it now? We know that the liquidity in that most important market has been failing since 2015. So you need to understand that Wall Street doesn't give a crap about stability. They just care about making a little bit of money. And I think this TYVIX shows that transition better than anything else that I've seen. And the whole system is definitely deeply at risk. And let me show you what great old Larry Summers allowed, because these are interest rate derivatives, IRDs. And this is the weekly notional amount. Now, whenever you hear or you see nominal or notional, What that means is that you have no real idea of the true value that is at risk. This is just an agreed market agreed upon price, right? And that's all this is a contract. But look at how this has grown from $500 billion, so 5 billion, and this was back in 2013 when they really did hand this trading market over to Wall Street, up to 8.4 trillion. This is on a weekly basis, people, a weekly basis. Because it should be very clear with all the crisis that we've been through that Wall Street is far, far, far more important than Main Street. But Main Street, you and me and everybody else will pay the price for it. Now, this is the number of trade accounts. So this is the notional contract value, what the market says that it's worth. And then this is the trade count. And you can see, again, from 2013, how many more trades there are in interest rate derivatives. They're playing with the foundation of our global system. Back in 2013, it was 7.3 thousand a day. Now it's 51.5 thousand. Oh, I'm sorry, a week versus a week. Can you see how much more that's grown? They don't give a crap about stability. They only care about making a little pickup in money. But again, I cannot repeat this too much. We have no idea of what the true value is at risk. That's true. The FDIC says it. The BIS says it. The Fed says it. Everybody admits we have no idea of the value that's at risk. But what we do know is that 71.4% of all derivatives traded are interest rate derivatives. And just going back to the Office of the Comptroller of the Currency, this is the notional amount of precious metals, i.e. gold, contracts. And where you see this huge jump here, it's because they were forced to value them differently starting in 2022, getting ready for the full transition into Basel III. So these were all big fat lies. Now my question to you is, do you believe this lie? Because I don't. I definitely don't. But does it have an impact on the spot gold market, which is what we've been trained to think of as gold? It's not gold. It is just a contract. It's not this, right? But it can certainly be used to suppress and control the visible price that we see. But how many times can you be lied to when you do not know the truth? And obviously the answer to that is every single time. Can you see how they can easily influence the market? And we're not even really seeing what's going on here. And my question is, hey, why isn't spot gold at $600 an ounce? It's certainly not going to reflect the fundamental value, because what you're looking at here is just manipulated garbage. It doesn't mean anything. It's a big, fat lie, an admitted lie. But when do you want to know that it's a lie? When do you want to know the truth? I say hallelujah and thank goodness that they actually are suppressing the price of gold, because when you're at this kind of level, this is just a raw 1 ounce Liberty, right? It's going to be reflective of that spot market. But when you go into the collectible market, that is a physical only market. That's where you see the truth. I've shown it to you many times in the past. I will continue to show it to you in the future, but you're going to find a whole lot more truth, and these have all broken out.
This topic warrants further exploration as we wrap up our exploration of the financial implications of interest rate derivatives for the Federal Reserve. We will be posting more insights and discussions on finance and economics soon. Subscribing will keep you updated on future analyses and updates. Until next time, keep exploring, keep learning, and keep questioning.